Okay, it's March 13, 11:14 a.m. We're looking at Bank of America BAC. So, this banking crisis, and we want to figure out what is going on, what Wall Street thinks will happen. We see here that this morning it has fallen to 27.87, and it's kind of bouncing back up now. Um, it's holding support at this level, at the 27. And we want to know, okay, so we look at the unusual options here. And this is what I saw, that at about 10:58, you could see here that 37 calls, 6,000 of them were sold. Okay, so that's interesting because then you will also notice here at the 10:58:47 millisecond, it's right here too. You see here, it's actually another order here at the same date, May 19. These two are actually the same order because it's the same timing, and this is 3,000. It's half of this. This is a 34 call. Okay, so what does that mean? So this large hedge fund institution sold 37 calls, 6,000 of them, and then bought half of that amount at the 34 calls. That's a back ratio, a ratio spread. So is it bullish or bearish? Let's take a look. Here is the options chain. Here it is. This is the 34 strike here. You'd see here the volume here, that 3,000. And then here's that 6,000 volume at the 37 strike. And if we look at the Analyze tab, you can see here, if I put it back on, this is the trade here, and that amount of quantity. This is the 34 and the 37 calls. You could see from this graph that this currently is trading at 29.48, Bank of America. This is a very clever trade because if it drops and crashes, they're not at a loss. It's capped. There is no loss, right? And it's just basically flat, still at zero here. And so, but if it bounces up, going all the way up to, let's say around here, 34.5, this break even mark right here, they will start to become profitable, right? All the way from 34 to this level at around 40, you see here. You see the mark here at about 40 is the break even here. So anywhere from here to 34.5 to 40, if it comes back up by May, they're going to be very profitable. This here is above the 0 point. And so long-term wise, they think it is going to go up by and be profitable. But in case it doesn't and it crashes, they are protected. So if we look at this 34 and 40 mark, and we look at the charts here, that's actually around right here, right when this crash started. So they believe it's going to start to recover at this 34 mark. And if it starts to come up above that, they're going to be very profitable, right? They are only at a loss because it can crash all the way to zero. They're not going to lose any money, right? It's zero all the way. If it goes all the way down to, they're not going to lose any money. So as soon as the only way they're going to lose money is if it starts to come up right away within like this week. You'll see the purple line coming down right away. These are losses, but as time passes, this is going to move back up, right? As time starts to pass, this curve is going to go up as it approaches their the Mays. This is all going to be profit. So as long as it never crosses this 40 mark, they are going to be profitable. And so this is how the hedge funds are taking advantage of this volatility, this opportunity. They see this as an opportunity, this crash as an opportunity, because the chance that it's going to break 40 by May is also very low. This is 40. It's never hit 40, Bank of America. So to them, this is a very excellent trade where they're going to profit from in this May period expiration. So yeah, that's the analysis of what the hedge funds on Wall Street are doing. And if you like this analysis, subscribe and hit the bell icon so you will get notified immediately. Take care, everyone.